Okay, hello everyone and welcome back. My name is Greg Furman and this is the Vantage Point AI Market Outlook for the week of March the 11th, 2024. Now, to get started this week, we're going to go back to our main intermarket correlations here so we have some idea what's going on with these markets after a data-fueled week. We had Fed testimony. So let's look at the actual performance of the S&P 500. We are most certainly not up 1.15% on the week. We are basically flat. We're barely up anything on the week. As you can see, there's our opening on Monday and our close on Friday. But for the month, we are up a mere 0.54%. So we're also going to work in the VIX here to see if there's anything going on with the intermarkets that are telling us the equities may not be as strong as what they appear to be. So what I've done is a comparative analysis to the dollar index. The dollar down slightly, as we can see, 1.39%, but the dollar is firmly still above its current yearly opening price. Now, if we go back a random 5 days or a random 30 days, we're not seeing these true performance uh, the true performance model, because we're looking to see at the beginning of the month, the end of the month, what buyers and sellers are doing, the main fund. So as we can see that the dollar is struggling here on a very weak payroll number. It was not good at all. Unemployment rate going higher, U6 going higher, things moving in the wrong way. But I firmly believe that that number was leaked and they knew this, and that caused a spike in gold last week, which we'll talk about in a minute. But the main thing we want to understand is the true performance. The S&P 500 for the month of March with a proper anchor point, we can see that we're basically up virtually almost flat on the week, and on the month a mere 5.4%. So when we look at the global equity markets, we can see that the DAX, basically the same thing, on the month is only up a mere 0.34%. On the week it's did slightly better as we come back to 5 days right here. Then the DAX is up slightly on the week, but not much. Now, the key thing we're looking for here is to remain above our yearly opening price, and more specifically, our T-cross long. That's coming in at 17,516. But again, the DAX, like the S&P 500, is actually struggling here in the month of March. It's nowhere, neither one of these two are nearly as strong as what you would think, despite that US dollar moving lower. Now, when we look at the treasury bonds, we can see the treasury bonds firmly responding to that dollar weakness, up 1.97% in the month of March, using an accurate anchor point to gauge the performance. If we go back a random 30 days from the 7th or 8th of March, then all we're doing is creating lag in our performance, our true performance model, and what we're further doing is causing confusion as to what is the market? What are these markets really doing? Are they bullish or bearish? So the treasury bonds immediately responding to that dollar weakness. Now, when we look at some of the additional European markets, the CAC 40, again, it's up a mere 0.15%, which essentially mirrors the S&P 500 for our March performance. Because again, I don't want to drag whatever was going on in January and February. The last thing we want to do is drag that into March, because again, it creates lag and it creates distortion in price, in my respectful opinion. But again, the CAC 40 firmly above its yearly opening price. I would argue that this may be a little bit toppy. Our T-cross long here coming in at, again, 79.01. We need to hold above that in order to remain long. Now, when we look at the FTSE 100, we can see that the FTSE, again, not anywhere near as strong as what the CAC 40 and the DAX, the CAC 40 and the DAX are. We can see our yearly opening price on our FTSE here is coming in at about 77.55. So again, we're below the yearly opening price, the current yearly opening price, and we've been below that the entire calendar year, showing that the FTSE out of the global indices is one of the weaker ones. But there is one that's even weaker, which I'll show in a moment. But we're holding above our T-cross long, 76.42 for the global index traders. This one here looks like it's getting ready to break down, and I would argue that this is largely based around that strength, which I'll show in a moment, around the British pound. So if the pound continues to extend, it's likely to put additional pressure on the FTSE. Now, when we look at the Dow Jones Euro Stock 50, again, firmly above its yearly opening price, its monthly, and our T-cross long, we've got 1.15%. So the Dow Jones Euro Stock 50 outperforming the DAX, outperforming the CAC 40 and the S&P 500. And this is what we look for here, is to see where the strength is on the global markets. Now, again, when I'm looking through these, the Nikkei 225 is actually down 2.8%. This is coming directly, in my respectful opinion, from the carry trade starting to come unwound. If the market believes the Fed is going to cut sooner and more, then they're starting to get out of that long dollar yen trade, which is causing weakness in the Nikkei. The stronger yen, the weaker Nikkei. Very similar in the U.S. The stronger dollar, the weaker the S&P and the indexes. But right now, there's a rationale based around intermarket correlations why this is happening. Now, the Nikkei is basically stopped 2 days in a row right on our T-cross long at 38,917. We need to hold above this, and we need that yen weakening, which we may get next week. So there could be a buying opportunity here in the Nikkei. But I also believe the Bank of Japan could intervene at any time. Now, when we look at the Dow Jones, you can see the Dow Jones here. I'll just bring that up on the month so we can get an accurate view of what the real performance is in March. And we can't get that if we drag that something that's gone on back in uh, in January or February. So the Dow is actually down 0.76%. So the global equities in general all of a sudden don't look that great anymore, do they? So, and this is one of the things we have to take into consideration here. But again, we're holding above our Vantage Point T-cross long. That's coming in at 38,745, and we're firmly above our yearly opening price. Now, the Russell and the Nasdaq, when we look at these, the Russell is actually performing quite well for the week, 1.39%. So we're firmly now on the Russell above our yearly opening price at 2048. We're above our T-cross long at 2049. So the Russell looks to be performing a little bit better than the Dow and the S&P 500. But we also want to do a comparative to the NASDAQ contracts. The NASDAQ, again, the market's a little confused by this, but the Nasdaq is actually down 0.2% on the month. Again, this is factual performance, not a rolling performance model that is I believe, is causing confusion as to what the real performance is. So right now, we're still above the yearly opening. We're still above our T-cross long, but the Nasdaq too is struggling a little bit up here. But I believe we should be able to hold, and the Nasdaq is one of the better indexes to be involved in. Now, when we do if they're looking at the global indexes, we do need to look at the VIX to see if it's validated at anything that we've just discussed here. And when we look at the VIX, we can see the VIX in the VIX index in the month of March is actually up 6.79%. So, and we're challenging the current yearly opening price on that VIX. So again, if we break above 1501 and stay above that, that is going to put pressure, in my respectful opinion, on the global equity markets. But again, if I move this anchor point to just say, okay, 5 days or the last 30 days, then this would look completely different. It could actually make it look like it's positive, when in actual fact it's not. So again, we've moved above our T-cross long. We've closed at 1508. The yearly opening price is 1501. This is the first time we've closed above that yearly opening price in quite some time here, guys. We'd have to go back into January and February to find that. But the main thing is we want to make sure we're looking at that. In actual fact, we did challenge it here back on March the 5th. So now we're back up here again, and you can see how the market is using the current monthly opening price, not 30 days ago, guys. It has no relevance to anything. The current monthly opening price, the market is clearly buying the VIX off of that level, 1405. So for next week, First of all, we want to make sure we're staying above 1405, but I think the bigger area that we need to keep an eye on is 1501, because that would tell us that stocks are about ready to, if nothing else, start to move towards a corrective move lower across the global indexes, not just the US markets. And that's what I think most miss. Now, when we do the also comparative analysis between the S&P 500 and Bitcoin, once again here, guys, Bitcoin is becoming its own asset class where it's not as correlated to the equities as what it was. It's not as inversely correlated to gold. But the performance on Bitcoin just in the month of March currently is 11.69%. I believe it's up over 50-80% on the year also. But the main thing is Bitcoin has been a strong buy going all the way back into October, and the S&P 500 strength and weakness is having very little effect on it. And once again, this past week, and we worked on this in the VantagePoint live training room, using the T-cross long with the current monthly opening price, that monthly opening price is 61,337, was another excellent buying opportunity on Tuesday of this past week, because it's not a coincidence that it stopped exactly on that number and moved higher. But the Vantage Point indicators, the yearly opening price, the T-cross long, the indicators still said we're not going into a trend reversal here. The very minimum requirement we would need for a trend reversal is breaking down below the current T-cross long at 60,496 and breaking down below the current monthly opening price at 61,337. But again, if you move the goalpost by going with a random 30 days or a random 5 days of a rolling performance model, you wouldn't see this and you would miss this opportunity, which we did live in the VP live training room, because again, it's a very important number. You can see that in the first 3 days of the month, the market, Bitcoin just stayed right on that monthly opening and then ultimately broke higher, took a retracement lower back to its starting point and accelerated higher again. So leverage these levels, but if that T-cross long moves above the monthly opening price, I think we're looking at 80,000 on Bitcoin. So also keep this in mind. So now that we've had a complete look at all of these markets together, let's now bring in a quick review of our main Forex pairs and see how the dollar is faring against them. Now in this scenario, I'll move over to a different portfolio where I can bring in my main US dollar correlations to our Forex pairs. Now the MGA stock, this is a very interesting stock, and the only reason I look at it is because it has a 92.34% inverse correlation to the dollar. So if the dollar is really as weak as what they're trying to tell us, then this stock would be moving higher. And as you can see, it's not. It's struggling against the Vantage Point T-cross long, and it's been negative on the entire month. This tells me the dollar maybe is not as weak as what they're telling me. So again, I look at our T-cross long, which is 103.55. We are below that, but that doesn't mean the trend on the dollar has completely reversed, because again, we're up 1.48% on the dollar per year. The dollar has never been negative on the year. So the term bullish, bearish, we have to take that with a bit of a grain of salt and bring in an accurate measurement point, because quite frankly, I'm not overly concerned with what went on in 2021, 2022, 2023. I'm concerned on what's happening in 2024 because that's the current trading. So right now, the dollar remains positive on the year by 1.48%. That's a factual statement because I did not look at random dates. So a magna has not turned positive. So when we do our comparative analysis here, we want to look at things like gold. So gold, and again, I think there is a little bit of confusion as to what the real performance on gold here is. Gold has been negative, to clarify, the entire calendar year until just about a week ago. And even now, it's only up 4.4%. So I believe there's going to be significant headwinds up here around the 2200 mark, 2190. But we shall see. Right now, it remains bullish, but maybe a little bit overextended. And just maybe that payroll number was leaked on Friday, the previous Friday, because we have seen this in years past. There was the incident at one of the government offices where one of the fund managers called in and said, "Oh, can you give me that payroll number from the previous month?" And the secretary accidentally gave him the number for the current month 2 days before it came out. That was only about 5 years ago. So I suspect maybe something's a little bit off here. Our predicted differences on gold, they're starting to separate. They're showing potentially a little bit of weakness. But gold usually does fare very well between the end of March and mid-May. So it's perfectly normal for gold to go up. Maybe this is just a little early. So we'll see how this plays out. But this is not as strong is what it appears to be. Because again, I would be looking for that pink line, the predicted difference, to be still going higher. But gold, again, only broke above the current yearly opening price just a matter of 7 or 8 trading sessions ago. So all of the gains that gold has made are basically in the last week and a half, guys. Yes, we could look at it from down here and measurement down here, but it was still negative on the year. So I'm right now, our key support here, the T cross long, is 2053, and our yearly at around 2084, or excuse me, yeah, I believe that's correct. Yes, yearly at 2084. I believe it's a little lower than that. I'm going to say 2066, but in our software, 2084, we need to hold above that level. Now, when we look at our main Forex pairs, I'll start with the main one, Euro. So again, this is a very good retracement here, but I will point out the Euro is currently still down 0.82% on the year. It has never been positive in 2024. And that's where using proper anchor points and performance measurement points comes into play, because we can say, well, wait a minute, you're saying the euro is super bullish and it's been a really good long trade in 2024. That's what one of the analysts said, and that's actually not factual. It's actually never made money against the US dollar in 2024 and still hasn't. We would have to clear the yearly opening price at 110.38. Now we look pretty good. We're coming off our T cross long, but I would imagine there is going to be an epic battle at 110.38. So my job here is just to make you aware of two things. Number one, the euro has never been positive against the US dollar in 2024. Selling in rallies has been the preferred strategy. Number two, I'm not convinced the dollar is completely down and out yet. And I believe the central banks may strike back next week and say, no, we're still higher for longer. So again, we'll monitor this. Our T cross long is coming in at 108.49. That's our major support level, but our major resistance right now is going to be right up here at 110.38. Be very cautious around that particular level. When we look at the US Swiss franc, again, the Swiss franc has been unable to make any gains against the US, significant gains. Currently, it's down 4.05%. I believe the Swiss franc will start making significant gains against the dollar as we get past the latter part of March. So I believe we are going to start our corrective move lower. We're below our monthly opening price, 88.46. We're now below our T cross long here at 87.96, but I think the dollar has just a little bit of life left in it, because as I've talked about in previous sessions, that dollar seasonal pattern is strong between mid-February and mid-March. So maybe a little bit more, but these indicators are suggesting we are going lower. And if we're currently up, if we're 4%, guys, off our yearly opening price, then that means we've got 4% of downside with short trades here. That's a very attractive short, even with the interest rate differential. Now, when we look at the British pound currently, from a factual standpoint in 2024, is the only currency that is up against the dollar because it's positive on the year. You can't say something is bullish when it's negative on the year, or it's never made any money on the year. Not that the British pound hasn't tried, but you can see there's been multiple failures at the current yearly opening price. So we've managed to clear this. We're closing up around 128.59, but the British pound has made strong gains. If you go back to what I discussed about the FTSE 100, that explains why the FTSE is one of the indexes that's below its yearly opening, because they're not going into the FTSE, they're going into the British pound. So the British pound, pretty easy to figure out our supports, our T-cross long, 126.97, and more specifically, 127.32. As long as we're above this area, the British pound can extend higher, but we need to hold above that level. But again, pointing it out that that is the only currency that is actually making gains against the dollar based around that current yearly opening. The dollar remains strong at 4.17. We can see a direct intermarket correlation here, guys, between the Swiss franc and the Japanese yen. If one falls, so does the other. So right now, the dollar is starting to, with the first crack in the dam here is the British pound moving above its yearly opening price. We know we're getting dollar weakness this year, guys. It's just a timing issue. And it looks like we're starting to extend lower here. Now that monthly 149.98, our T-cross long 149.44, as long as we're holding below those two areas, then we're likely going to start trying to make a run towards this 141 area. But I will point out again, the dollar is still positive against the yen. When we look at the US Canadian pair, again, I think we forget that the Canadian dollar has not made any gains against the US dollar, despite this choppiness, the up and down, 5 days, 30-day rolling performance. Keep it simple, guys. When we look at this right now, the dollar is still doing well. If we measure it from the start of the year off the yearly opening price to where we are on Friday, once again, we can see the performance of the US dollar directly, and that performance is still up 1.65% against the Canadian dollar. Our T-cross long, 135.19, that is our key level, along with our monthly opening at 135.79. These areas here provide you with specific selling opportunities, or if you're a buyer, we need to get above these levels in order for this to extend, which I think will be difficult at this particular time. But the main thing is, to this point in the presentation, we've only seen one currency that's actually is positive on the year if you bought it against the US dollar, and that is the British pound. If we look at the Kiwi and the Aussie, we see something very similar here. We're down 2.74%. Yes, the Aussie is coming off strong off its monthly opening price, and yes, we have crossed over our T-cross long. So we use those levels below there for buying opportunities in anticipation of dollar weakness. But again, I need to point this out. The Aussie has not been able to make any positive gains against the dollar above that yearly opening price, which makes the Aussie one of the weakest currencies in 2024, along with all of the other ones I've mentioned. When we look at the Kiwi, we see the same thing. It's down 2.19% from this in the 2024 calendar trading year. It's very important that we understand that so we can gauge where we're at. The yearly opening here, 63.18, and yes, we've closed above our T-cross long. And if we connect the dots between this and the seasonal pattern of dollar strength ending by mid-March, then there is opportunity throughout these markets, throughout all of these particular markets, because again, nothing goes straight up and nothing goes straight down, and with that, we'll always have opportunity. So with that said, this is the VantagePoint AI Market Outlook for the week of March the 11th, 2024.